Hello and welcome to this week's edition of Hard Money. I'm Natalie Brunell. Before we get into the latest news, make sure you're subscribed to this page so you don't miss out on any new content, and hit like on the video so more people see it. All right, it's time for the latest Hard Money headlines. We begin, of course, with the latest developments on the FTX scandal. SBF criminally charged and in custody awaiting extradition. On Monday, authorities in the Bahamas, acting at the request of the U.S. government, arrested Sam Bankman-Fried at his home. SBF told a magistrate judge in the Bahamas that he will not waive his right to an extradition hearing to the U.S. The U.S. District Court in Manhattan's indictment included 8 criminal counts dating back to 2019, including wire fraud, securities fraud, conspiracy, money laundering, and violating campaign finance regulations. In one excerpt from the SEC complaint, it reads, quote, Bankman-Fried gave Alameda carte blanche to use FTX customer assets for its own trading operations and for whatever other purposes Bankman-Fried saw fit. In essence, Bankman-Fried placed billions of dollars of FTX customer funds into Alameda. He then used Alameda as his personal piggy bank to buy luxury condominiums, support political campaigns, and make private investments, among other uses. None of this was disclosed to FTX equity investors or to the platform's trading customers. Another remarkable revelation, SBF and his team, which included Alameda CEO Caroline Ellison, formed a group chat on Signal called Wire Fraud to send secret information about FTX operations in the lead up to its collapse. According to the New York Times, complex white-collar fraud cases typically take several months to build before an indictment is filed. Sources with the Times infer that since an indictment came down much sooner in this case, it's an indication that prosecutors have substantial information from cooperating witnesses. In several media appearances, SBF blamed FTX's failures on poor management and accounting, not fraud. It's unclear whether the federal authorities are looking at charging anyone else in connection with the collapse of FTX. SBF's arrest came on the eve of his highly anticipated virtual appearance in front of the House Financial Services Committee about the collapse of his exchange. That hearing, though, went on as scheduled without SBF, where we heard from John Ray, the new CEO of FTX. John Ray is an experienced corporate executive who most famously took over for Enron following that company's scandal. Ray had this to say about FTX while testifying before Congress.
Many questions remain. We know the following. First, customer assets at FTX.com were commingled with assets from the Alameda trading platform. That much is clear. Second, Alameda used client funds to engage in margin trading, which exposed customer funds to massive losses. Third, the FTX group went on a spending binge in 2021 and 2022, during which $5 billion was spent on a myriad of businesses and investments, many of which may only be worth a fraction of what was paid for them. Fourth, loans and other payments were made to insiders in excess of $1.5 billion. Fifth, Alameda's business model as a market maker required funds to be deployed to various third-party exchanges, which were inherently unsafe and further exacerbated by the limited protections offered in certain of those foreign jurisdictions.
The FTX scandal has a lot of regulators pointing the finger at each other at how such a large and sudden collapse could have happened. Representative Richie Torres has asked the United States Government Accountability Office to look into the performance of the SEC at failing to protect the public from, quote, the egregious mismanagement and malfeasance of FTX. Representative Torres also criticized Chairman Gary Gensler's leadership in general. Torres wrote, quote, if the SEC had done the due diligence of thoroughly investigating the financials of FTX, there would have been a greater likelihood of exposing the crypto exchange for what it truly is, a house of cards built on monopoly money printed out of thin air. By the way, Gary Gensler also finds himself at the center of a Freedom of Information Act lawsuit, which alleges that he scrubbed evidence of meetings with key Democrats, including Hillary Clinton and Nancy Pelosi, as well as the agenda for a meeting he held with left-leaning billionaire George Soros. Now back to SBF, we are learning more about his political donations. Based on data from the Federal Election Commission, he donated $40 million to candidates in the 2022 election. Records show almost all of that money went to Democrats. According to SBF, all of the money went to candidates who voiced support for pandemic prevention. Two senators each received $20,000 through joint political action committees. Those are Michigan's Debbie Stabenow and New Hampshire's Maggie Hassan. New York Senator Kirsten Gillibrand got $10,000, and Gillibrand, ironically, is co-sponsoring a bill that would have the CFTC oversee Bitcoin, Ethereum, and other digital assets, making them commodities instead of securities. However, following the FTX collapse, most of the political action committees tied to SBF have promised to donate the money. And it wasn't just politicians that SBF was donating to. He was also funding a number of news organizations, including The Block, a prominent crypto news outlet, ProPublica, Vox, The Intercept, and the Law and Justice Journalism Project. It's unclear what exactly was promised to SBF from the news outlets, but it raises suspicions that he could have been trying to buy positive coverage and political safety. Now, one of the media outlets we just mentioned is crypto website The Block, which we've learned SBF secretly provided funding to, and get this, one $16 million batch of that funding from Alameda financed the purchase of an apartment in the Bahamas for the former CEO of The Block, Michael McCaffrey, who has resigned and stepped down from its board. McCaffrey says none of the other employees at The Block knew about the secret funding and that it did not impact editorial coverage. The demise of FTX is also shining a light on celebrity endorsements. FTX paid millions to celebrities to endorse the exchange, and now we're learning just how much FTX paid. Shark Tank star and investor Kevin O'Leary, aka Mr. Wonderful, recently revealed that he was paid $15 million to promote FTX. While speaking to CNBC, he talked about the decision and what made him want to get involved.
I obviously know all the institutional investors in this deal. We all look like idiots. Let's put that on the table, okay? We relied on each other's due diligence, but we also relied on another investment theme that I felt drove a lot of interest in FTX. Sam Bankman-Fried is an American. His parents are American compliance lawyers. There were no other American large exchanges to invest in if you wanted to invest in crypto as an infrastructure play. So many of us said, wait a second, who's coming to this deal? We knew, for example,
This sounds like groupthink. Did you know there was no CFO?
Look, at the end of the day, to say that there was no CFO is also a bit of a falsehood. This was a nascent industry with a disruptor at its helm, creating positions that didn't have traditional names, okay? That's just the way it was. In retrospect, yes, it's a mistake. However, I feel obliged at this point to go to the end of this, particularly...
What does that mean?
It means that I need to find where the money went. I'm going to start with my own journey, with my own account. Bankman-Fried reached out to me last Saturday, and I said, look, Sam, I am just one investor, but my account has a zero in it, and there are no accounting records. Where did the money go?
O'Leary said he lost nearly $10 million in his FTX trading account and lost $1 million worth of FTX equity. We're sure to see a lot more developments and revelations in the FTX case in the coming days and weeks, and we just want to take a second to remind folks out there, not your keys, not your coins. Customers who held Bitcoin on FTX thought those assets were safe, when in reality, they were being spent and lent out behind closed doors. The safest way to hold your Bitcoin is in self-custody and cold storage. To learn more, head to our parent company, swan.com. U.S. officials are reportedly considering filing criminal charges against crypto exchange Binance and several employees, including founder and CEO CZ. The Department of Justice has been investigating Binance since 2018 over concerns that criminals were laundering money through the exchange. In a statement, Binance says they've always been cooperating with law enforcement requests and are, quote, dedicated to compliance and use of its technology to detect and deter illicit activity. However, Binance is seeing record withdrawals from the exchange. On Monday alone, almost $1 billion flowed out from Binance to other exchanges and external wallets. In an effort to avoid bankruptcy, Bitcoin mining firm Argo Blockchain is trying to sell some of its assets and restructure some of its finances. The company says the move should strengthen its balance sheet and improve liquidity so that the company doesn't have to file for Chapter 11 bankruptcy. The company also said they accidentally published information on their website last week that they filed for bankruptcy, leading to the stock being suspended from trading. This year has been especially tough for miners as Bitcoin's price has plummeted and there are high energy costs. Fresh off his appearance at Bitcoin Africa, Jack Dorsey's Block Company, not to be confused with the block we just reported on, and VC firm Stillmark are investing $2 million to bring new sources of energy to East Africa to help mine Bitcoin. The investment will go to a company called Gridless, which is a Bitcoin mining company already operating in Kenya. The money will help expand mining access across the continent, and Gridless designs, builds, and operates Bitcoin mining sites alongside small-scale renewable energy producers in rural Africa where excess energy goes unused. The funding comes as Africa experiences a grassroots crypto movement. According to CoinDesk, it has the world's highest proportion of retail payments and more peer-to-peer transactions than any other region in the world. All right, turning now to the macro picture. The Fed held its final meeting of the year and raised interest rates by 50 basis points. This was the 7th straight interest rate increase of the year. Here's what Fed Chairman Jerome Powell had to say.
I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do.
The latest consumer price index numbers have also been released. It shows inflation is moderating slightly. The year-over-year change in CPI for November came in at 7.1%, reflecting slower consumer price gains for the second month in a row. But an ominous warning from the world's largest asset manager. BlackRock is predicting a recession unlike any other we've seen in U.S. history. BlackRock analysts say we are undergoing an unprecedented shift in the global economy, and conventional strategies that have historically worked well in the past may not be as beneficial during this recession. They also add that with the Fed insisting on raising interest rates, a recession for 2023 is already a foregone conclusion. They also predict that markets have not fully realized this. Meanwhile, take a look at this. The interest expense on U.S. public debt rose to a whopping $766 billion over the past year, a record high. If it continues to increase at the current pace, it will soon be the largest line item in the federal budget, surpassing even Social Security. This is why many analysts say the Fed doesn't have much runway left when it comes to a soft landing. Over in Europe, where inflation remains even higher than here in the US, the European Central Bank is proposing a ban on cryptocurrencies, arguing they're harmful for the environment and compared investing in crypto to gambling. Fabio Panetta, a senior executive with the ECB, says proof-of-work mining should be banned for its high energy usage. Currently, EU officials have rejected bans on crypto mining, but the EU does require all mining companies to disclose their environmental impact. Panetta also disagreed with one of the core tenets of Bitcoin, that the economy does not need a trusted third-party system for transactions and that the public should embrace central bank digital currencies. Meanwhile, a potential strike could be on the horizon for staff members of the European Central Bank. The union representing the ECB workers themselves rejected the latest contract offer due to low pay and not keeping up with inflation. Shocking. They have until next month to get a deal done, and the last time there was a strike involving the ECB was in 2009 over pension reforms. The last story we want to mention out of Europe is there's a major controversy brewing involving several members of the European Union reportedly accepting bribes from Qatar. Greek socialist Eva Kaili is one of 4 people charged in this bribery scandal. She's accused of supporting several labor reforms that would have been favorable to Qatar. Officials also said they found bags of cash, about 600,000 euros worth, inside the home of 3 of her associates. Qatar has denied any wrongdoing. All right, inflation has impacted every industry over the last 2 years, and it appears that now the happiest place on earth might need to be relabeled as the most expensive. Everything costs more these days, but did you know how much it costs now for a day at Disneyland? In a now viral TikTok, a family of 5 documented their costs, and it's eye-popping.
Here's how much we spent at Disney day 2 of 5. A mediocre breakfast at Hollywood and Vine cost us $223. Then we headed over to Toy Story Land, and even with Lightning Lane, we still only got to ride 1 ride. Ice cream was $25 and popcorn was $16. Then over at Galaxy's Edge, 3 lightsabers cost us a whopping $800. They also no longer hold them for you until the end of the day, plus different airlines have different restrictions when flying home, so we opted to ship them to us for an additional cost. Every ride had a 120-minute wait time, so we only got to ride 1 ride in this section of the park as well. We tried the infamous blue and green milk and had lunch at Backlot and funnel cakes at Epic Eats. PhotoPass was an extra $170 for cell phone quality pictures, and finally we had dinner at Planet Hollywood. Factoring in our nightly hotel rate of $997 brings our total to $3,758.
The family did live it up while they were there, and even the new CEO, Bob Iger, recently admitted that prices at the parks are too high and need to come down. All right, those are the latest headlines. Coming up, we have an interview with Brian Estes of Off the Chain Capital. We're going to be discussing the concerns surrounding DCG, the parent company of GBTC and Genesis, which loaned to Alameda Research. And he's also going to share with us how we should value Bitcoin. Don't go away. Welcome back to Hard Money. Joining me now is Brian Estes, the CEO and CIO of Off the Chain Capital, which manages the #1 performing digital assets fund in the hedge fund research HFR universe from 2016 to 2021. Brian has been a VC in the space for over 8 years and has advised, mentored, and or financed 5 digital asset companies that have a combined value of over $25 billion. Brian, welcome to the show.
Hi, Natalie. Thanks for having me.
Well, first of all, I want to get your reaction to the latest SBF developments. He has officially been charged and is under arrest. A lot of people were eager to see this happen and the wheels of justice finally start to turn. So what are your thoughts?
My thoughts are like, it's about time. I know it takes the government some time to build their case, but it's obvious that he was using client deposits to cover losses in Alameda. And, there wasn't enough, I would call it big boy governance around SBF and FTX and, his, illegal activities has, finally caught up with him.
Well, I know that it's been about a month since they filed for bankruptcy. And Brian, as part of Off the Chain Capital, I know you've purchased Bitcoin out of bankruptcy cases. So can you break that down? Like, how does that work? And do you think there's any Bitcoin in the FTX collapse that could be salvaged and actually returned to depositors?
Right. And we're a value manager in the blockchain space. So, for example, we've been buying Mt. Gox bankruptcy claims for a number of years, which gives us access to discounted Bitcoin. With Celsius, FTX, BlockFi, all these platforms that were taking in Bitcoin and providing yield on them, that business model didn't work. So specifically with FTX, it's too early to know if there's any assets that are recoverable there. I would suspect that there are some. It's just too early to know exactly how much Bitcoin, Ethereum, and other assets that were deposited at FTX will be recovered. That information, the new CEO is working through that information as we speak. It's trying to take another month or two to get some more clarity. But then as FTX works its way through its bankruptcy process, then people who had Bitcoin and other digital assets at FTX, they may look to sell those bankruptcy claims. And that's when we step in. We provide that liquidity to buy bankruptcy claims from people who want to sell them.
That's really interesting. Well, I know that there are still some concerns that the crypto contagion is not over, with some people's attention turning now to DCG and its companies, crypto lender Genesis and GBTC, which has been trading at a record low discount. So what can you share with investors about DCG?
So for full disclosure, I've been a DCG shareholder since 2015. DCG owns Genesis. They also own Grayscale. And that's where the problem lies, is that when Three Arrows filed for bankruptcy, or before Three Arrows went into bankruptcy, Genesis had lent them billions of dollars, and the collateral that was put up was GBTC. And so when Genesis got their collateral, when they pulled their collateral back from Three Arrows, they pulled back GBTC. The problem with that is they can't sell it because Grayscale is their sister company at DCG, and the SEC restricts Genesis to only allow them to sell 1% of that fund per year. And so they have, $1 billion worth of GBTC, but they can't sell it. They can't turn it into dollars because of the SEC rules. And so that's where the problem lies, is that now that, Genesis has this capital or the collateral, they just can't turn it into dollars. In addition to that, they also owe Gemini $900 million. And so they're working with Cameron and Tyler Winklevoss to work out that problem too. And so what I like to say is just a big freaking mess over there. And hopefully, over the next few weeks, we'll have some more clarity on what the solution is to basically unclog the toilet.
Yeah, I know a lot of people will be monitoring it. We're actually going to have more in the show later on about DCG. But Brian, I know you do a lot of presentations around the world about how to value Bitcoin. So many of us out there, we value it just on the USD price, right? And that's wrong. Number go up, but how should we actually value Bitcoin?
Yeah, so there's actually a number of ways to value Bitcoin. When I first started buying Bitcoin back in 2015, I was buying it because it was cool technology. And I just understood that how we were going to rebuild our financial system on blockchain technology. I didn't know how to value it then, but over the last 8 years, we figured out ways to value Bitcoin. One of the best ways that we have is using what's called Metcalfe's law. So Metcalfe's law is how you value a network. And basically you square the number of users, you multiply that times the transactional value that goes through that network, and that builds this model price. That model price on Bitcoin is 94% correlated to the 13-year historical price of Bitcoin. So it's a very accurate model. And that model today says that Bitcoin should be worth $41,000 and it's trading for around $17,000. That difference between the $41,000 and your $17,000 price, that's your margin of safety. As a value manager, you want a large margin of safety between the price that you pay for something and the value that you receive. And the value that you're receiving is $41,000. That's what the network is worth. It's $41,000 of Bitcoin. And so that big spread between the price and the value is your margin of safety.
One thing that's always been inspiring to me is seeing those charts where you watch the adoption grow of different technologies. And it seems like Bitcoin is outpacing a lot of them with, I believe, 1 billion users expected by 2025. So here's to hoping to that. Brian, you're part of a team that's producing a big budget documentary film about Bitcoin. I believe it's called God Bless Bitcoin. So what can you tell our audience about that film? I understand that it's going to be looking at the moral aspects of Bitcoin.
Mm-hmm. Yeah, what we're trying to prove is the moral and religious case to have a sound monetary policy. And where that comes from is, the central banks that produces currency or dollars, they produce 2 to 9% more dollars every year. And so for most people, they don't understand what that means. So let me explain it. When you take your time, which is limited on Earth, you have a limited amount of time that God gives you on Earth, and you add some energy to that, and you add some skill to that, that creates value. And that value is paid to you in, a paycheck or in dollars. But when the government just prints 2 to 9% more dollars every year, they're basically stealing your limited time, your energy, and your skill to do that. And so that's immoral. And so that's what the movie's about. It's about educating people about the immorality of the fiat system and how there's a more moral system that's based off Bitcoin, which is, in my opinion, the most moral form of money humans have ever created.
Brian, for people that hear the title, God Bless Bitcoin, maybe they're not religious, why should they go see the movie?
Even if you're not religious, even if you don't believe in God, most people are still moral people. And I'll give you a great example. If you bought a bottle of wine and you drank half of the bottle and then you filled it back up with water and you put the cork back in it and sold it as a new bottle of wine, would you consider that theft or being immoral? I mean, most people, if they're not religious, they would still consider that immoral. And that's what central banks do. They take our dollars and they dilute them, just like diluting wine with water. And we use these diluted dollars, and that's why prices keep going up. It's because it takes more and more dollars to buy the same thing. And so that's immoral. And like I said, what the movie's about is to go through, how money works, the monetary system, to help educate people on why they're working more and more and they still can't keep up with higher prices. And it's because your time and your energy is being stolen from you. And there's a better monetary system out there.
That's such a good analogy. I'm going to have to use that one about the wine bottle. Well, we wish you the best with that film, Brian. Thank you so much for joining us today and for all of your insight. That was Brian Estes of Off the Chain Capital. And don't go away, because coming up, we're going to have a special report on DCG, Genesis, and you guessed it, GBTC. Did GBTC arbitrage trading kick off the crypto contagion? Stay tuned after these messages.
This holiday season, give the gift of Bitcoin to your loved ones. Swan delivers your Bitcoin gift along with our world-class education and client service. Create a Bitcoin gift and wrap it with a custom message for your family and friends. Dash away with your gift. Your recipient will receive an email right away, that easy. Give the gift of generational wealth. Give Bitcoin.
Satoshi gave us money that isn't debt. I like to use the phrase, a fool and their leveraged Bitcoin are soon parted.
These poignant words spoken by Caitlin Long at the 2021 Bitcoin conference in Miami echo ever more powerfully today, especially given that she said them sitting right next to Sam Bankman-Fried. Her wisdom, it would seem, fell on deaf ears. In the run-up to the catastrophic crypto exchange meltdowns of 2022, leverage was the name of the game, and the losers took all.
A lot of the crypto contagion that we've seen in these lending companies and hedge funds, you could almost trace it back to two things. And one is the ultra accommodative monetary policy of the Federal Reserve, which allowed rampant speculation. And now it's the opposite. So now we have tightening monetary policy, and that has led to the blowups of all these Ponzi schemes and highly leveraged organizations. And then the second thing is that GBTC, the Grayscale Bitcoin Trust, the failure of the SEC to convert it into a spot Bitcoin ETF.
The Grayscale Bitcoin Trust, which trades under GBTC, has been a major talking point in the Bitcoin community for years.
So the Grayscale Bitcoin Trust is the largest Bitcoin fund in the world. It holds right now about $10.8 billion worth of Bitcoin.
More than 600,000, right?
Yeah, 635,000 Bitcoin is sitting in this trust. That's about 3.3% of Bitcoin circulating supply.
Analyst Sam Callahan, who has done extensive research on Grayscale and its effect on the Bitcoin market, explains the convoluted story of what was perhaps the first domino to fall in this epic financial fiasco.
GBTC is what they call a closed-end trust, and that allows the investors to gain exposure to Bitcoin without buying Bitcoin itself. And so it's technically a security. And so that's why it became extremely popular over the last several years, because for a long time, it was the only way to get exposure in these tax advantage accounts like IRAs and 401ks.
Bitcoiners often say, don't trust, verify. So the very nature of GBTC, literally a trust, is a bit counter to the ethos of Bitcoin. Yet many hodlers felt they had no choice but to add GBTC to their retirement portfolios because of the Byzantine rules of our legacy financial system and the lack of suitable vehicles for owning the underlying asset when most bought in. But Sam explains the Achilles heel of this instrument and the arbitrage trade it created, which over time led to catastrophic results.
The important part is you can't take the original Bitcoin out of the trust. You can only sell those shares of GBTC. And the reason this is important is because it creates a dynamic where the share price of GBTC can trade on the open market above and below what the underlying Bitcoin of the trust is worth. And so that's called the net asset value. This dynamic of premiums on the GBTC trust created this trade that became very, very popular amongst institutional investors like BlockFi, like Three Arrows Capital.
BlockFi and Three Arrows Capital were two of the largest funds to take advantage of this premium to NAV spread in what became known as the Grayscale trade. Here's how it worked. The institution would give USD or Bitcoin to Grayscale to create GBTC shares at Bitcoin's net asset value. Some of them took on significant leverage to do so, loans to the tune of billions of dollars. And then those GBTC shares were locked up for 6 months. When they went to sell the GBTC, those shares were trading at a premium to NAV, meaning the institution got to pocket all the gains.
So when they sell the shares 6 months later, and if the shares are trading at, a 25% premium, they collect that 25% difference. It's basically free money.
Making matters more fragile was the fact that lending firms like Genesis were providing the capital for these trades and were owned by the same parent company as Grayscale itself, both under the umbrella of Digital Currency Group, or DCG.
Genesis was giving the leverage to these organizations, so they were making money off the loan originations. They were just making a killing, and they would give them the leverage to put on this trade. Three Arrows Capital and BlockFi were making a killing by collecting premium.
Three Arrows Capital co-founder Kyle Davies, now based in Dubai, relives the glory days on a podcast with Hugh Hendry.
Because of this business model, they would go out and say, we understand the trade you're doing. We're going to lend you a lot more than what we did before, hundreds of millions, right? At the end, billions. That becomes the whole system, basically. I think one of the last calls we did, someone lent me high 9 figures, almost $1 billion, off a phone call. And it was that was the final one. That was like uncollateralized. That's where the system was. Like, people needed to get dollars out the door.
Well, I mean, it sounds like you were operating on the basis that if they were as unprofessional, naive to give you that line of credit, then you felt duty bound to take it.
If this sounds a little like the lead up to the 2008 mortgage lending collapse, it's because it is. A credit bubble based on hype and the belief that prices on an asset will keep going up. That is, until they don't.
So everyone was winning on this trade, and they acted like it would never flip, but they were very, very wrong. And when that premium flipped to a discount, where the actual trades were now trading below the value of the Bitcoin underlying the trust, that's where things really started to break down.
On February 24th, 2021, the GBTC premium flipped to a discount and started trading below net asset value.
These firms like 3AC and BlockFi are kind of caught with their, pants down because they have this illiquid 6-month holdup, and now it's a discount, not a premium. It just hit an all-time low of 47%.
Three Arrows Capital, Voyager, Celsius, BlockFi, and of course FTX are all casualties of this house of cards. But what about Genesis and its parent company DCG, also parent to Grayscale itself? Genesis found itself with a massive hole in its balance sheet, and DCG effectively took over the liability. Sam sees 3 reasonable outcomes, including DCG trying to raise money, restructure its debt, and the third, a so-called Goldilocks scenario for GBTC holders.
If Grayscale went to the SEC and asked for a Reg M relief, and what that would mean was that they would allow GBTC shareholders to redeem shares of the underlying assets at a 1-to-1 ratio. So if Reg M relief was approved by the SEC, the GBTC discount would disappear overnight, and Grayscale would be able to create and redeem shares and return the fund back to NAV.
But that would mean the SEC is essentially choosing winners and losers and protecting investors by effectively helping Grayscale, which is unlikely. More likely, though, than Grayscale voluntarily liquidating the trust is shareholders voting to transfer the trust to a new sponsor instead. What's the biggest lesson?
Biggest lesson is don't use leverage. It kills. Beware of counterparty risk, and take your Bitcoin off exchanges.
Again, a fool and their leveraged Bitcoin are soon parted.
Now let's go to some macro analysis with Andy Edstrom. Andy?
Hey, Natalie. The two big items this week in the macro world were, of course, the November CPI number and the Fed's interest rate hike. The CPI print on Tuesday showed that consumer prices rose 7.1% in the past year and rose 0.1% in the past month. Many market participants took these levels of increases as a sign that we've passed the peak of consumer price inflation, and U.S. stocks rallied on the back of this news. Also, the Fed raised the federal funds rate by 0.5 percentage point, or 50 basis points, as expected. So the Fed funds rate now stands at 4.25% to 4.5%. As usual, it wasn't just the rate hike that the market was focused on, but also Chairman Powell's commentary that came with it. Powell said that the Fed wouldn't consider rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. Investors took this as a sign of hawkishness, and on Thursday, U.S. stocks reversed the gains of earlier in the week. Powell and other Fed officials reiterated the fact that they expect to keep rates higher through next year, with no reductions forecasted until 2024. And according to the Fed's dot plot, they expect the federal funds rate to reach a peak of 5 to 5.25%. Interestingly, investors don't seem to believe Powell's commentary and forecasts. This is evidenced by the fact that the market is currently forecasting only a 25 basis point rate hike by the Fed in February. It's also evidenced by the fact that the U.S. Treasury curve remains very inverted, with the 5, 10, and 30-year Treasury yields all well below the current Fed funds rate. Now, one interpretation of this inversion is that investors believe we might soon experience a mix of a recession and weakening consumer price inflation, which would lead to the Fed cutting interest rates. In order for the yield curve to become positively sloped without the Fed cutting rates, we need to see the Fed's soft landing scenario play out, which would allow them to raise and keep rates higher for longer. Over the next few months, we'll get more evidence of which of these two scenarios is playing out, the recession leading to rate cuts or the soft landing with rates higher for longer. I have to say that my money is on the recession.
Thank you so much for watching this week's edition of Hard Money. Our goal is to give you the latest headlines impacting Bitcoin and the global economy while bringing you original interviews straight from the biggest names in the space. I'm Natalie Brunell, and I'll see you next week.